You've probably heard the term private equity thrown around, but never really explained. So let's break it down with something everyone understands: a pizza shop. Imagine a small pizza shop in your town. It's decent, but it's struggling. The owner is tired, sales are flat, and profits are shrinking every year. This is exactly the kind of business private equity firms look for. Not a failing business, but an underperforming one with hidden potential. A private equity firm, let's call it Apex Capital, steps in and buys a majority stake in the pizza shop. Let's put real numbers on this. The shop is valued at $50 million. Apex Capital puts in $10 million of their own money and borrows the remaining $40 million from a bank. This mix of equity plus heavy borrowed money is called a leveraged buyout. Now, Apex Capital takes control. They don't just sit back and collect checks. They actively fix the business. They renegotiate supplier contracts to lower ingredient costs. They fire underperforming staff and hire a stronger manager. They redesign the menu to boost profit margins. And they use a strategy called a roll-up, buying two smaller competing pizza shops nearby and merging them into one stronger brand. In just 4 years, the one struggling pizza shop becomes a 5-location chain with double the profit margins. Now, Apex Capital sells the entire chain to a larger restaurant group for $150 million. After paying off the $40 million loan, that leaves a massive profit split between the firm and its investors. This is the private equity playbook. Buy an undervalued business using mostly borrowed money, improve operations aggressively, then sell it for a much higher price. Typically, PE firms hold a business for 4 to 7 years before exiting, either by selling to another company, taking it public through an IPO, or selling to another private equity firm entirely. So who actually provides the money for these deals? Wealthy individuals, pension funds, and institutions called limited partners, or LPs. The private equity firm itself acts as the general partner, or GP. They manage the fund, and in return, they typically charge a 2% management fee plus 20% of the profits when they sell. Sound familiar? It's the same structure hedge funds use. Now, here's where people get confused. Private equity is not the same as venture capital. VC firms invest small checks into early stage startups with big potential, but no profits yet, hoping for one massive winner. Private equity firms buy mature, already profitable businesses using large amounts of debt and make them even more profitable through operational changes. And here's why it's called private equity in the first place. Unlike buying stocks on the public stock market, these deals happen privately between the firm and the business owner, away from public exchanges. Your ownership is illiquid. You can't just sell your shares tomorrow. Your money is typically locked in for years. There's also a darker side to this story, because PE firms often use so much debt to fund these deals. The acquired company inherits that debt on its own balance sheet. If the turnaround doesn't work, layoffs and aggressive cost cutting can hit hard, which is why private equity is controversial in certain industries, especially retail and healthcare. But when it works incredibly well. Struggling businesses get fixed, investors get strong returns, and in some cases, jobs are actually saved instead of lost because the business survives instead of shutting down completely. So next time someone mentions private equity, just picture that one small pizza shop turning into a 5-location chain, run smarter, priced better, and sold for millions. That's private equity in a nutshell. Spot undervalued businesses, buy them using leverage, fix what's broken, and sell for a profit years later. Simple, right?